And Tom.
Lisa, thanks so much. Paul Sweeney and Tom Keene here with a great set of conversations for you. We welcome all of you across the nation. We welcome you in Chicago. We welcome James Bianco. I will make it as clear as I can. No one, with the nodding exception of Mohamed El-Arian, no one nailed resilient inflation coming out of COVID like Jim Bianco. He joins us today with Bianco Research. Jim published moments ago at Apollo Global Management. Torsten Slok had huge respect from his time at Deutsche Bank. I quote Jim, "Container ship departures from China to the U.S. are collapsing when consumers cannot get the products they want from abroad and the products that are imported are more expensive. The outcome is a slowdown in U.S. consumer spending." Jim, you know, consumption 70% of GDP. Are you modeling out a tepid real GDP?
Yeah, I think that the real growth in the economy is going to slow. I don't have it going anywhere to like a recession. I also think the other thing you got to keep in mind that gets very little discussion is the closing of the U.S. border, because most of the population growth of the United States comes from immigration, whether it's illegal or legal. And that's going to dramatically slow. And that's also going to slow down the economy as well. But again, I don't think these numbers are going to produce anywhere near an inflation or, a recession. And also, I don't think that cutting interest rates is going to solve these problems. All cutting interest rates are going to do is try to inject what we have with steroids, and it's just going to produce more inflation. It's not going to produce higher growth.
I'm not going to mince words, folks. The conversation that John Farrow had yesterday with the Secretary of Treasury was the single best conversation I heard, because it allowed us to hear Bessent theory. John Authors is quite critical. He'll be on later in the show. And now we have Jim Bianco. What does Bessent get wrong, Jim Bianco, about 4, 5, 6, 7 rate cuts?
Everything. Can I say that?
He's so
basically,
diplomatic.
He said,
he's such a gentleman.
Yeah, he basically said any model suggests that that interest rates should be cut by 1.5% to 1.75%. I'll come back and say to you that there's no model that says that if you have a 3% interest rate, that you should be cutting interest rates by that much. And John Authors authored something about that yesterday, and he'll talk more about that. That the idea that interest rates should go below the inflation rate when the inflation rate is this high is unprecedented. It's never been there when it's been above 3%. It should stay above the inflation rate by some premium. And that's why I think that the current funds rate at 4.25 to 4.5 is very close to neutral. And that's why I was saying earlier, if you want to cut interest rates, and the Fed looks like they're going to, you're not going to get the desired economic growth outcome. You're going to get an inflationary outcome.
So, Jim, going back to the labor, and again, we're going to get initial jobless claims today. What is a reasonably, I guess, decent growing economy? How many new jobs per month does an economy need that's growing at a decent clip?
This is the question that economists seem to be skirting. With the population growth slowing as much as it has, and the president putting out a Truth Social post last week saying we might have net negative immigration growth, more people leaving the country than entering. For the first time in American history, the population growth might be down around 0. If that's the case, you can make the case that anything, and I'll quote the American Enterprise Institute has put pen to paper on this, anything around 10,000 jobs a month might be enough. So when we freaked out about 19,000 jobs, 14,000 jobs, 73,000 jobs, what we were doing is we were assuming this is the way it was when we had the border open and we needed 80 or 100,000 jobs a month. We're now in probably a 10,000 job a month range, and that is enough jobs. And again, if you're going to cut rates because 10,000 jobs is too small, you're just going to produce inflation.
Bottle it, folks, what you just heard there from James Bianco. Paul, I hereby call it the Great Reset. That's why I'm stealing that from Lisa Mateo. She has a great reset with Uncrustables, but I'm calling it the Great Reset. People don't understand what Mr. Bianco said. And Paul, I got a bunch of questions on this. Please step forward here, Paul, and continue this discussion, folks. This is so important in honor of Angus Madison about a changing America.
Jim, as a result of kind of what we've just been talking about here, are we in a world of just elevated inflation? Should people get used to what they're paying in the supermarket, for example?
I think we are. I mean, the Fed has a target of 2%. They cut interest rates last year in September of last year, a year ago, when the core inflation rate was over 3. The core inflation rate's 3.1 right now. They're about to cut interest rates again with it over 3. Forget what they say. Forget that, Jay Powell, will say in his September presser that we're strongly committed to our 2% target. They're cutting interest rates with it above 3. So they're telling you that the 2% target is no longer the target. It's closer to 3. Now, why does that matter? Indeed, the website that does jobs did a study, and they said something like 35 or 40% of the American public is not getting raises equal to the 3% inflation rate. So that's probably the bottom 35 or 40% of income. So we're just going to tell those people, sorry, your job is going to continue to give you raise increases above the inflation rate. So every time you go to the store, you have to buy less things because prices are moving up faster than your paycheck. And that's where that becomes important. I know a lot of people on Wall Street shrug their shoulder. 2, make it 3. What's the difference? For a third of the country, it's a big difference if you can't get the inflation rate down.
Jim Bianco for you folks. Just a brilliant conversation. Your commute across America. Good morning. Sirius XM channel 121, 99.1 FM, Nathan Hager Radio, Washington, 92.9 FM in Boston. Good morning. Bloomberg 1130 in New York. Hope you survived the rain. Paul and I came in today with our Wellingtons on. The wellies were needed last night. It was pouring rain. Jim, let me ask you the question again. Folks, an interpolation is where you have a belief and you have something else to look at and you try to guess or interpolate what the number should be. So Jim Bianco, if I have flat population growth as a general statement, and I've got the way we frame the unemployment rate, let's call it 4.2, 4.3%, to pick a number, when we do a Bianco interpolation, is 4.5% the new 5% unemployment rate?
No, I don't think it is, at least in that regard, because, not to get too wonky, but the unemployment rate is measured on a household survey. And that's one of the reasons why I think you saw with the payroll report falling, the unemployment rate didn't rise. We don't have, with slow population growth every month, thousands of people entering the workforce. Either they're turning 18, which is one way you can enter the workforce, or they're coming into the country new, looking for a job. So that's why you could have slow payroll growth and not high unemployment. And I thought it was kind of interesting because Chairman Powell has mentioned the supply of labor, which is their phrase for slowing population growth, and said he's more interested in the unemployment rate than he is in the payroll report. Because if nobody's coming into the country and no one's looking for a job, these slow numbers may not produce higher unemployment. So I think that, the 4.2 number is what it used to be. And that's why it's not going up. The unemployment rate was 4.2 a year ago when we were still producing 100,000 jobs.
How do you carry this over to the equity market? If we talk about a flatline demographics, does that mean a more tepid, demure stock market?
Not initially. I mean, the stock market is all about cheap money, and it sees the Fed is going to be cutting rates, and it's celebrating the idea that cheaper borrowing costs are coming, and it's going to keep going from there. But over time, yes, it will take away some of the growth of the country. Nominal GDP will go down. That's real growth plus inflation. That should, over time, hurt earnings. And over time, let me go on another direction here for you. It should help to correct housing. Because one of the problems with housing is there's not enough houses. Everybody talks about the affordability crisis. When we have home prices at all-time highs, we don't have enough houses. Well, if you slow down the number of people that need houses, over time, that should correct itself too. Now, it's not all good. I mean, you'd rather have growing population faster than slower, but those are some of the immediate effects if this continues.
Jim, are you surprised the U.S. dollar's not rebounded like the U.S. equity markets have rebounded?
Not really, because I think what the dollar did was after Liberation Day, when it disconnected from interest rates, it reconnected. And so when you get lower interest rates in the U.S., you tend to get a lower dollar When you get higher interest rates, you tend to get a higher dollar. So I think the big driver of the dollar right now is back. It wasn't for a while, but it's back to being interest rates. So as long as they're headed down, I think that's going to keep the dollar relatively weak. Most currency traders are playing this relative interest rate game. Where can I get the highest interest rate? And if our rates are going down, it becomes less attractive.
Hey, Jim, we pretty much through the second quarter earnings here. How do they look to you? How's corporate America dealing with this current economic environment?
It's looking great. I mean, about more than 80% of the S&P 500 companies beat. The guidance that the companies have given has been the most positive in 4 years. The outlook for the second half of the year looks very good. So at least in the interim, it looks like if you were to judge corporate America as an economic indicator, they're telling you that the economy is doing very well.
Jim, I think your comments on the Secretary of Treasury are apt. And again, John Authors was scathing, and we'll have him on here later. At the beginning, I thought John Farrell was brilliant. At the beginning, Jim Bianco, the Secretary walked through his belief of the diffusion of tariffs from the export country to the importer at the shore to the consumer. And to me, with all I've read, including Douglas Irwin, the classic at Dartmouth, it was all Greek to me. Critique the Trump-Bessent theory that the consumer won't pick up the burden of these tariffs. And the zeitgeist this morning, folks, is Michael Barr. He is every morning in the food court, folks. Michael Barr has a bowl it's a bowl of Raisin Bran with a banana on it, but it's actually a bowl of bananas with some Raisin Bran. I mean, Jim Bianco, the bananas alone are already killing us. Are these tariffs going to pass on to the consumer, unlike what the Secretary of Treasury says?
I think eventually they are. You're right. There's three people that can. Let's bear in mind that tariffs are up by about $250 billion. So to put it in the vernacular, somebody's paying an extra $250 billion for product that we weren't because of tariffs. Who's paying that? Well, you got three choices. The export country, that means China cuts its rates, Japan cuts its prices. Japan cuts its prices of things that they ship to the United States. That might have been happening in the first 30 or 60 days after Liberation Day, but it looks like it's reversing right now. They did it as a panic right away, didn't know what to do, but now they're starting to reverse that and bring it up. The other one is the importer, the company that imports it. They're going to cut their prices to the consumer. Well, as I mentioned with corporate America, margins are fine and corporate America earnings are doing fine. There's no sign that they're eating $250 billion worth of prices. So that leaves the price at the store. That will eventually start to go up. And there's some evidence that those prices are starting to go up. Remember, in May, June, July, what you were paying for was stuff that was already imported without tariffs. But as you get into August, September, October, and further, now the stuff that's going to be on the shelves have that tariff price embedded in it, and that's going to start to creep higher.
Jim, this has been absolutely brilliant. Thank you so much. Jim Bianco with us today. Really appreciate it. Bianco Research. Can't say enough. Folks, this is what surveillance is about. The